What is an overnight reverse repo? Have you ever wondered how the Federal Reserve manages money in the economy? One of the tools it uses is called an overnight reverse repurchase agreement. This financial transaction is quite interesting and plays a key role in our economy. So, what exactly is it? An overnight reverse repurchase agreement, often shortened to reverse repo, involves the Federal Reserve selling securities to eligible counterparties. These counterparties usually include money market funds and government-sponsored enterprises. The agreement is simple. The Federal Reserve sells these securities with a promise to buy them back the very next day. In this arrangement, the Federal Reserve acts as the seller of the securities. Essentially, it borrows money overnight from these counterparties by offering them securities as collateral. The next day, the Federal Reserve repurchases these securities at a slightly higher price. This process effectively means the Federal Reserve pays interest on the overnight loan. This mechanism is particularly useful for managing liquidity in the financial system. By temporarily absorbing excess liquidity, the Federal Reserve can help control short-term interest rates. This is where the connection to fiscal policy comes into play. From a conservative viewpoint, reverse repos allow the Federal Reserve to influence interest rates without directly printing more money. However, some conservatives express concerns about the extensive use of such tools. They worry that it may lead to unintended consequences in the financial markets. The balance between managing monetary policy and allowing market forces to operate freely is a topic of ongoing debate. In recent years, the overnight reverse repo facility has been used more actively. It was established in 2014 but gained prominence during times of high liquidity in the financial system. By providing a place for money market funds to park their cash overnight and earn interest, the Federal Reserve can maintain control over short-term rates. This is especially important when banks are less inclined to hold reserves at the Federal Reserve. By doing so, the Federal Reserve aligns broader money market rates with its policy goals. In the context of free market economics, some argue that the Federal Reserve's intervention through reverse repos can distort market forces. They believe it artificially influences interest rates. However, from a monetary policy perspective, these operations are designed to ensure stability in the financial system. By managing liquidity and interest rates effectively, the Federal Reserve aims to support economic growth. Understanding overnight reverse repurchase agreements helps us see how monetary policy works in practice and its impact on our economy.